Okay traders, welcome back to the channel. Here we have the US 30 daily chart in front of us, and I'm going to be going over a daily analysis, price action review, and an overall case study of a potential New York trade you could have taken last week. So here we are on the daily time frame, and we have a couple of concepts just to point out right from the get-go. So again, what we have over here is we have the structure that's been pretty much bullish. Of course, higher time frames, longer term time frames, we are of course bullish in this particular market. But if we dive into most recent price action here on the daily time frame, what we see over here is we see a structural low down over here. So this is a structural low, which I'm going to label in black. So here we have a market structural low, and this here is our market structural high. So we have a dealing range, right? Swing low and swing high. So if I make that visible for people to see, yep. So what we have over here is we have a swing low and we have a swing high over here. So this is our structure, right? So we have bullish structure we're currently dealing with. Now, there's four things which you need to understand when it comes to building a narrative or building a higher time frame bias or a narrative. The first is your market structure. Now that's something we've already established based off this two structural dots. We have a structural low and we have a structural higher high. Now the second thing you want to identify when it comes to identifying and creating an overall bias is the dealing range. What is the dealing range? You know, are we in a bullish dealing range or are we in a bearish dealing range? Well, currently as it stands, we have a bullish dealing range, and the way we signify a bullish dealing range is quite simple. We simply project the Fibonacci tool from the swing low up to the swing high like this. So this here gives us our dealing range. We have a bullish dealing range to currently work with. Now, after we've established that, the next thing we understand, which pivots directly from the dealing range, is that we have a premium and discount array. So this 50% level represents the equilibrium, okay? So the equilibrium gives rise to two specific areas on the price chart. Anything above the 50% level becomes a premium, and anything below the 50% level becomes a discount. And this is going to be very important when it comes to understanding where to buy and sell from, and which fair value gaps and which POIs are of a high probability. So the third thing we look at is we simply look for PD arrays. So we need to understand where the PD arrays are, where the premium and discount arrays are. So that's the third thing, very important thing, ICT concepts. And the fourth thing we look for, which also relates to ICT concepts, is the concept of a fair value gap, right? Inefficiencies in price, right? Where has the market left inefficiencies? And our job is to target these and trade away from them post mitigation. So of course, how do we identify a POI? Well, a POI, simply put, right, is an area that's in discount or premium that leaves a fair value gap. So over here, I've zoomed into a fair value gap, a region which is in the deep discount region. And so what we mean by this is that we have a fair value gap over here, which I'm going to label in blue. So this is our bullish fair value gap just here in this region. And again, it's important to understand where this is priced current respective to the current dealing range. So this is the 50% level over here. And as you can see, this is deeply, very firming discount, which gives rise to our POI. So where is our POI? How are we going to mark out a point of interest based off this knowledge over here? Based off this fair value gap? Well, it's quite simple to understand, right? I get a lot of questions about this in the private community as well at Liquid FX, right? How to identify POIs? What makes a POI? How to identify a high probability POI? So I have made a separate video on this, which I highly recommend people checking out. But to quickly run you through the rules of a POI very quickly. So what makes a valid POI? Well, there's three things, right? We want to see the POI break market structure. We understand we are bullish in terms of our market structure. The second thing is we want to identify a fair value gap or an inefficiency in price, which is marked out just over here with the blue box. And the third thing we want to understand is that the POI itself must be in the discount. In this case, it must be in the discount because it's a bullish POI. If it was a bearish POI, you would look for the fair value gap and a break of structure in the premium. Okay, so what's happened is we've had a break of structure here to the upside. And now from here, we understand that the easiest way to choose a POI is is the candle just before the inefficiency. So this here represents the candle of inefficiency over here. This is the candle of inefficiency. This is the imbalance, right? This is the imbalance. And so once you've identified the imbalance, you're essentially mapping out the candle before. So that here, logically, that here is this candle over here, right? So this is our daily POI, which I'm going to mark out in gray. So this here represents a daily point of interest or a daily POI. And so with this in mind, what we do is we simply project this over to the right. And it's no surprise that the most recent bullish price action has been a result of this mitigation over here. So if we quickly zoom out to on this particular market, we understand where we've reacted off, right? We've reacted off an extreme discounted region, as an extreme discounted POI, filling this fair value gap here to the left before heading higher, right? So this is the overall outlooks on the US 30, right? We understand we have a rejection wick over here. Why is this a rejection wick? Well, it's simply because we've filled in and we've mitigated any fair value gaps to the left over here. So this gives a strong indication for higher prices. Simply using the concept of structure, fair value gaps, and premium and discount, right? The bread and butter of all trading. Another confluence we should understand is that we had a very large pool of liquidity over here. So if I quickly bring that to your attention, we had a very large pool of liquidity here. This represents internal range liquidity. So what makes this internal range liquidity? Simply because we have our dealing range. So our dealing range is essentially this region, right? So we've got this swing low up to this swing high over here. So this is our dealing range. So anything internal to the dealing range becomes internal range liquidity, right? So this here represents internal range liquidity. So we've had a mitigation, we filled a fair value gap. And so from here, the overall narrative in price would be to head higher. So what gives us a conviction for higher prices, right? There's a few things. And it all comes down to basically two things, not even a few things, only two things, right? What does the IPTA or the interbank price delivery algorithm seek for in the first place? Well, it seeks for two things, right? It seeks for liquidity and it seeks for inefficiencies or fair value gaps. So it's the same concepts, right? Once we've swept liquidity to the downside, once we swept this liquidity, right, we understand we swept this liquidity, we're going to be targeting the next liquidity pool and the next area of inefficiency. And how do we do that? So if I zoom in again and bring to people's attention, now we're dealing above this 50% level. So anything here is a premium. Okay, anything here is a premium. So what we have over here is we have yet again another fair value gap in price. So this here is our inefficiency, right? So the red lines over here represent the start and end points of the inefficiencies, right? So here we have sell side inefficiency or a sell side imbalance just over here. One reason for higher prices, but also important to understand and note is that we have a high over here. This is currently the all-time US 30 high, and this is the low down here. This high over here currently stands as a weak structural high, and the reason why this is weak is simply because it has not made a new low. Remember, the low is down here, and this low simply projected lower, filled the fair value gap, and headed higher. So this here is a liquidity pool, right? This here is a liquidity pool. So if I mark that out, this here is a weak structural high. Weak structural high. And what makes this a weak structural high is simply because it hasn't made a new low, and to give us extra an extra confirmation or extra confluence for higher prices on US 30 is the fact that we have a fair value gap just underneath it. So the overall narrative on US 30 points to very much bullish or higher prices, okay? Simply using the daily structure. So without using any other time frame, we can sieve out a very clear structure, a very clear narrative to follow over the next days and possibly weeks as well, as we go to make potentially a new all-time high on the Dow Jones. So now if we go down to the 4-hour time frame, well, the 4-hour time frame will paint a similar picture to the daily time frame, of course. Again, what we had over here, quickly marking this out, is that we had our bearish structure over here. So we had a switch of structure from bullish down to bearish. Okay, so we had price giving us a structural high over here. So this structural high I'm going to label in orange. So quickly, if I were to label out my US 30 4-hour structure, it would be like something like this. So we have a structural high over here, then we had a structural low, we had a pullback, and we had a structural low, and we had a pullback, and we had a structural low down here. So we have bearish structure over here. Now from here, we see a shift of market structure. So where do we see that shift of market structure, and how do we see it? Okay, so what we've seen over here is we've seen the last structural high over here get broken. So we see a clear break of structure over here. Right, so if I quickly label that for people in black so they see, this is a structural break to the upside. So this is our first break of structure. And so from here, we see a high form in this region over here. Now from here, we see price giving us a pullback, more than 2 candles. We see a pullback before heading higher. So we see a correction in price, giving us a higher low. And now the most recent high has also been broken again. So we have confirmed bullish structure. So to quickly take you back up to the daily time frame. The daily time frame over here has a fair value gap just over here. So we have a fair value gap over here that needs targeting, right? So we understand that we build a bias from the daily time frame down to the 4-hour time frame. Okay, so this red line over here represents a daily fair value gap. So I'm going to label that for people so they understand. We have a daily fair value gap over here. This is a daily fair value gap. Okay, so when we go down to the 4-hour time frame, this now becomes our target. Right, we understand this becomes our target. And what gives us an extra confluence, right? What gives us an extra confirmation is the fact that we've had structure delivering us not only one break of structure and a pullback, but we've had a second break of structure. So we've had a confirmed shift of structure from bearish to bullish, okay? Now, quickly to signify this pullback even more, we understand that this is a significant pullback simply because we've had a structural low down here and we've had a structural high over here. Notice how prices come into a firm discount, filled the majority of this fair value gap over here, and has since then rocketed higher. So overall, our next target on the US 30, so for those who are interested in the exact price is 39,500, right? This is roughly where we're going to be looking for, 39,500. This is the next overall target where I think US 30 is going to go, right? So 39,500, okay? Building a bias from the daily time frame down to the 4-hour time frame. So now when we go to the 15-minute time frame, again, we have our daily fair value gap to target, right? But here, how can you take advantage of that, right? How can you get involved in a potential bullish trade that goes in line with the narrative, right? So I'm going to be dissecting down a 5-minute entry, right? One of the entry models that I use here at Liquid FX, right? So here we have the 4-hour low down here, right? We can ignore that for now. And we're going to be going over a basic concept of accumulation, manipulation, and distribution, okay? Starting with what we have over here, we have the Asian range, right? The Asian range is a low volume time of day that builds liquidity in the markets, right? The accumulation engineers liquidity in the markets, right? So the key thing to understand with this Asian range is the timing, because time and price is very important. That's the bread and butter of ICT. That's the bread and butter of all of the ICT concepts. It is time before price. And what do I mean by that? So we have the Asian session range, or ASR for short. The Asian session range is a low volume time of day, and the times you want to have allocated on your chart for the Asian range is this. So we have 7 p.m. New York time, 7 p.m. New York time to midnight New York time, or Eastern Standard Time, should I say, right? So when we have the Asian range over here, we understand that the New York midnight opening price, so at midnight, the IPTA resets. And this red line represents an IPTA reset, okay? This red line represents an IPTA reset. So again, going into the London session, what we see is we see price head down. So you want to ask yourself, if price is bullish overall, why are we going to go down in the first place? What is the purpose, right? Why does the London session give us bearish activity? What is the point of all of this over here, right? What is the point? You need to understand that the market moves in 3 phases, right? There's 3 phases to the market, right? There's, of course, as we know, we have step 1, which is the accumulation. Accumulation. Oh, if I could spell, that's the wrong spelling. So we have the first step, which is accumulation, right? We have our second step, which is manipulation. manipulation, and we have our third step, which then becomes distribution, right? And our job as traders is to catch the third leg of this cycle, right? The distribution. So how do we do that? The best way to do that is to actually understand when the accumulation occurs and when the manipulation occurs, because if you can time the manipulation, your chance of timing the distribution is much higher. And that's what we're going to go through in this quick case study. So when we see price heading down to the downside, right? So when we see bearish activity like this, which I've highlighted in red, you have to ask yourself, the market will move down before it goes up. So we see this down movement to go up. And so what do we mean by that? Right, we understand that we have the Asian range over here, and we have the Asian range low. So when we see a sweep of the Asian range low as we have, what this essentially represents is a bearish manipulation. So we're looking for an accumulation of price, we're looking for a buildup of liquidity, and we want to see a sweep of that liquidity before we head higher, right? So this here represents the manipulation. So the way you want to picture this in your heads, right, the way you want to understand this is that this here entices sellers into the market, right? It entices sellers and it builds buy-side liquidity. So BSL or buy-side liquidity is generated, right? So let's go through the chart and understand what this means, right? So what we're looking for is a Judas swing. So once we've swept the Asian low, we've enticed sellers into the markets, right? So we've enticed sellers. So where are these sellers likely to keep their stop losses? So we understand just of basic liquidity principles that there's going to be liquidity all around in this region over here. This region here marks out liquidity. And the reason for that is that we know from basic SMC concepts that above every trend line, above every equal highs, equal lows, everything, there is liquidity that forms in this region. So this is a liquidity pool that gets formed. So whenever we move down in the market, price always leaves buy side liquidity, right? This is buy side liquidity. So understand that. So now we're going to do something which I call a Judas swing identification, right? Understanding where the low of the day is going to form. And the low of the day typically forms below the Asian range, right? So now we are below the Asian range low, or the ARL, the Asian range low. We are below this range. And so what do I mean by that, right? So we understand we're looking for a very simple market structure shift. So we're looking for lows and higher lows and lows and higher lows before we see a shift of market structure. Then we want to key off a fair value gap. So we're simply looking for the market to perform a cycle very similar to this, right? So if we go now to the live markets, what we see over here is we see price giving us a low, high, low, high, low, and then we see a break of structure to the upside. So again, what signifies the first break of structure, right? And therefore what signifies the Judas swing is this move right here. This is the break of structure to the upside, right? BOS, or break of structure to the upside. This here represents the first sign of the Judas swing. So once we've had a confirmed shift of structure, which we have done, we've had another confirmed high, low, and then another high over here. So this here confirms our Judas swing. This here is an ICT Judas swing, or a manipulation, or a turtle soup. Lots of different names, but they all mean the same thing. So this here represents our Judas swing, okay? So now that we've identified two of the three phases, we've had an accumulation over here in orange, we've had a manipulation over here, the ICT Judas swing, and now we've had a break of structure to the upside. So this here validates the accumulation and the manipulation. Now we need to look for the distribution. And how do we look for a distribution? Well, we simply key off an order block, right? So what makes an order block, right? An order block is essentially a time-based fair value gap that we want to key off. So what we are looking to understand firstly is that you want to ask yourself, what time does SPY actually open, right? Sorry, not SPY, the US 30, or SPY or NASDAQ, sorry. So we have the indices, right? So the indices market, the US indices market opens at 9:30 Eastern time, right? Which corresponds to 2:30 p.m. here in the UK, right? So indices opens at 9:30 Eastern time, or 2:30 UK time. So your job is to identify a fair value gap within that region after the open. And here's where we have it over here. So we see how we have the large impulse candles over here to the upside. This here is our fair value gap just over here. right? This is our fair value gap, which I'm going to label now in blue. So you want to ask yourself, what time did this fair value gap actually form? So this fair value gap itself formed bang on at the open, right? So when we see a fair value gap form at the open, what this represents is it represents bullish price action, right? We understand we've had a Judas swing over here, so we're keying off a fair value gap in line with the overall higher time frame trend, which of course is bullish. So once we've identified that, we understand that again, just like on the daily time frame, our order block is the last candle prior to the inefficiency. So this is our order block just over here. This is our 5-minute order block. Exactly the same as a daily time frame, right? So this is our bullish order block over here, right? M5 bullish order block, right? To quickly go over the rules of that, what makes an order block? Well, it's the exact same rules that make up a POI. So there's 3 things that make up an order block, and there's 3 things that make up a POI. We've had a break of structure. We've had 2 breaks of structure. So we have structure on our side. That's the first thing, right? Structure is broken bullish. We understand we have a fair value gap over here. So the market has given us a reason to mitigate. Go down lower, mitigate a fair value gap before heading in the intended direction. And the last thing we need to understand is that for this particular bullish range, right, we understand we have a structural low down here. So you've seen a high, we've seen a low, and this low produces a structural high over here. So notice how this M5 or this 5-minute order block lies below this equilibrium level. So this here is the EQ or the equilibrium. Anything below that is a discount. So we need to be buying in the discount. This is one of the basics of ICT or SMC, whatever you want to call it. This is essentially how you want to key off an order block using the same basic principles. And so from here, once you have all the rules in check, from here, riding the distribution becomes quite easy. Again, a safe place to keep the stop loss will be just below the, you can either have it below the Judas swing like I tend to do, or you can have a little bit above because there isn't any fair value gaps over here. Keep a safe stop loss. You don't want to be too greedy with the stop. And so from here, it goes to show you that once you have the higher time frame direction sorted, right? Once you understand which direction the higher time frame is going, it then becomes very clear to then trade in line with the trend, right? Again, we had FOMC, which bolstered the overall trade. But once you understand basic price action techniques, understanding the AMD, everything from there does become quite self-explanatory.